All right. So, yeah, we got a guest here today. Super excited about it because so many people reach out and ask us about this idea of like private money or alternative lending. And apparently they're all too cheap to check out the Patreon. Haha, just kidding. But there is great stuff on our Patreon where we talk about seller financing, private money, all these sort of things. But we wanted to break it down here with an episode for everyone. So, Neal, you want to introduce our guest here?
Yeah. So for once, we actually brought in my boy. We always call everyone my boy, but this is actually my boy. It's Ryan MacNeil from Graysbrook Capital. Yeah. Say hello, Ryan.
Hey, guys.
And
glad to be here.
Yeah, he has done, every time I've alluded to private financing, like 99% of it has been through Ryan. He's been the guy that I text when I'm in a tight bind, and he's looked over all my numbers, and he's gotten me out of different
Neal sends
deals.
Ryan these texts at like 1 a.m. You up? Winky face? Winky face $sign?
Yeah, exactly.
He's my boy after all. So.
Today we're going to go over basically all the questions you guys would be interested in hearing, cost breakdowns, what it looks like for them to loan for you guys, things they don't want to see, and then also some of Ryan's opinions on stuff that Tiff has said. Tiff MacNeil, he came and presented here in Halifax, and where we see rates going, potentially where we see the market going with foreclosures and all of that. So, let's hop right into it and maybe do an intro here for yourself, Ryan.
For sure. Awesome. Well, first off, thanks for having me, guys. Really appreciate it. You guys do awesome work on this podcast, and
thank you.
Great to be a guest. As Neal mentioned, name is Ryan MacNeil. I'm the Director of Alternative Lending for Graysbrook Capital. Been doing it for about 5.5 years. Business has grown substantially in the last couple of years. It's been 5.5 years, but it's felt like a lot longer the way the real estate market's been the last couple of years. So I feel like I've had a career and a half of experience in that time. Just a little bit about me. I in a past life similar to Neal was an engineer. He's got the ring showing right there.
Giving those things
away. I don't
wear
mine anymore. That lasted about 8 months for me, so I quickly realized it wasn't.
Neal will be buried with his.
Absolutely, absolutely, very proud. I don't blame him. It kind of led me to my passion, which was business. I ended up going back to business school, did a couple co-op terms, did the Bay Street thing for a little bit, and realized I didn't want to be part of the Bay Street fashion show, nor working 120 hours a week. That led me to the consumer goods industry, where I got to work with a couple Fortune 500 companies. Got my training in sales, key accounts, working in like business analytics, and that really laid the foundation for me for my career. So despite the fact that the first time I learned about a mortgage was when I bought my house 5 years ago and started selling mortgages the next day, I felt I had kind of the foundation there with my analytical and sales skills to kind of build a network and, meet many broker and realtor partners around Atlantic, and led me to where I am today.
That's actually quite an impressive background. I knew about the engineering. I didn't know about all the other stuff. So that's, and like you said, it leads into you being the perfect person to fit this role, I think, honestly.
Thanks.
So you've had a crazy couple of years. Did you enjoy the last couple of years, though?
Definitely enjoyed it. Maybe less so in this unpredictable market we're in right now, but certainly enjoyable. It's gone very well for our business, let's say. There's been a heavy need, and I know we were talking about it before we started recording here, that there's been a much heavier need for private financing for a multitude of reasons, which I'm sure we'll get into. But it's been very good and a lot of learning for sure.
So who is Graysbrook, though? Because people may not be familiar with you or have heard you by name, but don't really know maybe your connection to credit union, for example. Yep. So what is Graysbrook?
Absolutely. So in the simplest terms, Graysbrook is an equity lender. So that's what we're looking for at the end of the day. We're an equity lender. We focus on short-term deals, typically 6 to 12 months, sometimes a little bit longer, sometimes by our choice, sometimes not by our choice.
Neal's the lifetime.
You saw how he looked at me when he said that.
Neal's the lifetime commitment package.
He's paid his bills. It's all good. Yeah. So really at the end of the day, we focus on equity and exit strategy. Those are the keys with Graysbrook. We do a multitude of different deals that we'll get into, but just a bit of the background on Graysbrook. So Graysbrook was originally a family business. So my dad and my uncle actually founded this business in 2006.
Oh man, I did not know that.
Yeah, so that's how I actually got into the business. So,
no way.
Because it's very difficult with the disparities in incomes in Ontario. I should have mentioned as well, I was in Ontario for my business career initially. Moved out east when I had this opportunity with Graysbrook, but so I was very fortunate to come back into a family business. Like Chandler alluded to, our business was sold to CUA in 2019. So CUA is basically our parent company. our sole investor. We still operate completely independently and make our decisions independently of CUA. But that's when kind of my father and uncle moved away from the business into retirement, and I was able to kind of take a leadership role within the business at that point.
So are you from Halifax?
I was born in Halifax, grew up in Moncton, and went to school in Fredericton, and then moved to Ontario after that for about 10 years.
Gotcha. I know that's interesting history to know because I didn't know that in advance of this. But I was always felt that alternative lending, private lending was like the big bad boogeyman. And oh my gosh, you're dancing with the devil if you go down that road. And this is a digression from what was on here, but that was kind of my naivete early on. And it's not to say it's without risk. It does have risk. But it's interesting. It actually kind of gave me a sense of comfort to know that you were affiliated with CUA and it's like, okay, this isn't just some guy, right? Even though, and it's also kind of endearing to know that it started from a family business. So.
It's a financial tool. Like it's something to utilize along your growth and to get up. Like I said, I use it to get started, and a lot of times you have to when you're getting started because most banks will laugh you out the door.
Yeah.
Right.
That's it, Neil. It's intended to get our clients from point A to point B, right? We don't want people staying with us long term or too long of a term because that's when issues start to happen, and we want people to be successful.
So who is your target?
So target clients. And I'm glad you mentioned that as well, Chandler, being the big boogeyman, because that often is the myth that comes along with private lending and with Graysbrook Capital in general. Some people have the stigma associated with it that it's people with damaged credit or have been through multiple bankruptcies.
Yeah.
But we actually have a very strong credit profile for most of our clients, and they tend to be high net worth. So I'd say the ideal client profile we see is someone who is equity rich and maybe needs cash flow for a variety of different reasons. Often we see business for self clients who don't claim their full income, but they do make a ton of income that just happens to stay in their business.
Yep.
And I'll get into construction and renovation loans a bit more as well, but that is another one of our key kind of clientele, people who have some experience in that field, whether it's construction, trades, home renovations, home flips, because we love those types of deals, and that's where we tend to have strong client profiles as well.
And so, as that client, are you looking for people that are building homes? Are you more interested in renovating properties? Is it like what is kind of the ideal, asset that goes along with that person? What type of people do you go after?
Yeah, so both. Typically the equity in a scenario like that, if we're talking construction, is in the land. So we like to see the clients either own their land or put maybe 50% towards the land purchase price.
Yeah.
So they've got kind of skin in the game that way. Renovation loans will do as well. It's always case by case. We prefer stronger locations, of course, as well. Although we have done some in rural areas as well. So it just really depends on loan to values and a multitude of factors. But we fund renovations. We base our decisions as well off of the as complete appraisal. So it's not necessarily just what your cost is going to be for the renovation or construction. It's really what it's going to appraise out at the end of the day that we're basing our loan to value on.
Yeah, we talk a lot about that as well in the Patreon episode. But so I think you've unpacked a lot of it there, but what are the benefits kind of working with you guys? There's the speed, obviously, and Neal touched on the fact that, someone starting off, AA lending just may not be an option for you.
Yeah, I'll say one minute before you answer, but like I said, I mentioned there was the speed. We were talking about this before we came on the mic, but I was able to text Ryan and within probably 48 hours have cash in my accounts. That one was so, and what's funny is I started in this private world working with Ryan, and so then I moved over to the banks after, and I did not realize how slow a draw can be. By the time you got an appraiser in, got the percentage complete, sent it to the bank, it went through the 13 levels that they need to get it approved, then they come back with 10 questions, and it goes back through those 13 levels again, and then the funds get sent to a lawyer, and then the lawyer lets go of it once they're ready to go. It's like 3, 4, 5 weeks, if not longer sometimes. So I didn't realize how lucky I was.
And you touched on the difference you still need appraisals, and appraisals have to happen, and they take some time. An individual still has to have things like NOA or something equivalent. You might need rent rolls, all that sort of stuff. Yeah. But it's after you've dressed this perfect package and you send it to an A lender. They're we're going to look at it for 5 to 6 weeks, and then we're going to fund whenever the heck we feel like after that, as far as I can tell. And the difference,
speaking from a spot right now.
Well, the difference is you guys have a bit more autonomy and less rungs to go through where it's all right, here's a complete package. We can take a look at it and make a decision.
Absolutely. So we're making all the decisions in-house and we make them quickly. So that's the key thing at the end of the day is speed, like you guys both alluded to, right? So we're turning things around. You know, we've done some deals as fast as 24-hour turnaround times, and that's from approval to funding. Typically it's 48 hours, and we almost guarantee everything is done within 7 days. So it's very quick, and that really what.
But
sets
that's
us
from the
apart.
time of like having the appraisal, having the full application.
Absolutely.
Yeah.
So you need to have the appraisal in, and that includes like legal and getting the funds out the door, right? So, you know, things have to kind of fall into place for that. But you mentioned appraisals as well. So yes, we do need to have an appraisal done, but like in your situation, Neal, as well, I'll even go to site sometimes and do inspections rather than having an appraiser, waiting for that appraiser to go and schedule it in 2 weeks from now, send a report. You know, I can usually go there and determine whether the windows are in or whether a home is weathertight or not. It's not that difficult.
Yeah.
So, you know, that's one benefit
That's where
we
the
have as
engineering
well.
degree comes in.
Absolutely.
Just knowing if the windows are in.
It took 5 years to find out about how that works, but
The other key thing I wanted to mention as well, and this is one we really pitch, is that our mortgages are fully open as well. So yes, our
that's
rates
huge.
are going to be higher than you're finding at the bank because you get the advantage of speed and other factors and flexibility, which are big things for us. But the open mortgage aspect is key because if you're with us, you know, and you get your project done in 6 months, 8 months, 12 months, whatever it might be, you don't have to pay those penalties on the back end to break the mortgage. You pay us out, it's clean, it is what it is. You refinance your property and Bob's your uncle.
To that note about flexibility and stuff, what are some unique situations that you guys have come across that you've dealt with, maybe regarding like environmentals, burnt down buildings?
What are you alluding to?
And just other like weird scenarios like that.
Sure.
What have you guys like looked at that I think most banks wouldn't have the risk appetite to take on, but you guys have gotten into?
Yeah. So I can chat on a couple examples there, and if you don't mind, Neal, we'll chat on on your property that you know is quite a unique one as well. But so Neal had this property that he brought to us. I guess it was 3 or 4 years ago now that had burnt down. It was in a decent area of Halifax, I guess. Up and coming, we'll say, but it's one of those ones where there's different factors, but we were still able to be in first position. I think there was a vendor take back associated with it to kind of help offset your down payment. But for us, we're still secured in the fact that we're in first position. We were about 65% LTV. I think there might have been another asset that we leveraged, maybe a personal property or another property you have, just to kind of as a sign of good faith for our first deal together. And that's one there where we based it off the as complete value again, right? So you were putting in the renovations to get this place up to spec, and build it up and increase the rents, and all went smoothly. We took a bit of a gamble on you, but seems to have worked out pretty well so far.
You also had the advantage of you had a contracting company right through your restoration company, right? Like so that helped the application as well.
Yeah, we talked about that a bit too, and I think we put it. I remember sending in a resume, I think, to you guys as well as like a background that I had the contracting company, I had the engineering degree, and then we put up. I had a duplex that I was living in.
Oh,
and we
I
put
would
that as a
love
secondary
to see. Can we
collateral.
get a copy of that resume? I would love to see.
I
that.
was really
dated.
good at Nintendo
1-year
64.
dish pit at Moxie's.
Yeah. Worked with a dishwasher.
No, but that's interesting. But even that, just like the subjectiveness, the freedom to be like, all right, well, what's the total picture here? Because other lenders, if you don't fit in that box, it's like, well, you don't fit in the box, right? Where you've got the discretion to say, okay, what's this person's credentials? One, he's a licensed real estate person, so he should kind of know a little bit about what he's doing. He does have access to tradespeople and an understanding of pricing. All those things can kind of roll into it. Like, what for you would make a deal killer versus a slam dunk? Like, what's if someone says, I've got this situation, here's my equity position, like what you're like, okay, that
what
right
kills
there.
a deal for you guys?
Yeah, so deal killer. I'll focus on that one first. I'm glad you guys brought this one up. I got a good story for this one. So, this is one here. So if you got like a super rural property and it's super high LTV, chances are that's not getting through. But this is a funny one, and we've seen this example come through a couple times. And there's one in particular that I remember from a broker partner we had, and it came in and the deal, I think, was in Spring Hill, Nova Scotia. And no offense to the good people of Spring Hill, Nova Scotia, just not one of our
Was it an old decommissioned mine?
It was about $100,000 property, 80% LTV, and we're typically in that location maybe 50, 60%.
Right. That's loan to value for people who are kind of
loan
like,
to
okay,
value,
that
correct,
means the person wanted to borrow 80% on the value of the property, 100,000, and you guys would be more comfortable in a location like that, like 50% of the value.
Exactly. Just a risk mitigation tool, right? So this particular client had either 1 or 2 bankruptcies in the past and was currently in consumer proposal. He'd borrowed his down payment from his sister and his cousin or something like that. But the broker, and he pulls in, we're all sales guys here, and the broker pulls out the sales tactic. He says, but he's a really good dude. And I looked at my underwriter and I said, well, you should have told us that first. He's approved, right? So, but I thought that was a funny one, and we get that all the time. I know this guy really well. He's a really good guy,
Cool.
right?
So, do you want to spot him 100,000?
Yeah. We're going to lose 30 grand on this deal, but at least he's a really good dude. So no big deal. So I'd say that's kind of the biggest deal killer is something that's high LTV, rural locations, past credit issues where it's more likely that they're going to default, because we don't want it. There's also that stigma out there that private lenders are in there to go get properties. That's the furthest thing from the truth. We have zero interest in the time that goes into having to chase money and sell off a property and the legal process associated with that. So really no interest in that. And in fact, that leads us to sometimes being more flexible to make sure that client does get out and does successfully, whether that means selling their property, refinancing, or whatever else to get out of the loan.
Yeah. I mean, there's some people who I think believe that private money could be a catch-all for anything. And I know I sometimes feel like a buzz killer. People are like, well, listen, I want to buy a 12-unit building. I have no money, and I'm not gainfully employed, but I'm a hustler, and I'm going to find a seller who's going to do, a 15% vendor take back, and then I'll just do private money for the 10%, and then I'll just get a loan. It's like, man, it's not quite that simple. You still have to have skin in the game. You still have to have a solid overall portfolio. You still need to have some cash. There's this misconception that you can just run around with 0% deals all over town, but you need some cash.
And that's exactly it, Chandler. I think, skin in the game is key for us. So yes, there is certain scenarios where we will, accept a vendor take back, but if the client's only putting 5% down or trying to do 0% down, we're not interested in that. It's too easy for them to walk away from the deal if something goes sideways. Yeah. And then we're, kind of stuck with that asset.
Now you're a proud owner in Spring Hill, Nova Scotia.
To your point, I mean, I know some deals you guys have worked on that you guys will work with your client to help them get through their exit strategy, because again, you guys are not interested in reassuming the property, especially in today's that last couple of years. People believe that because I think if they get the property, they can throw it on market and get 10x their investment.
Sure.
But in a normal market, there's a lot of times if you take a half renovated property that you've now
the next person can't finance it.
Budget,
the person buying it can't finance it. Right?
Person buying can't finance it. It's not fully done. You know what I mean? So you run a huge risk in assuming that property. So we've talked about some of the deal killers. What's something outside of maybe credit score and income that would be a great way to get approved? Obviously, is it just really appraisals your number one big thing, making sure that there's equity in that, or is there another thing that you see it comes across it's a nice bonus to have?
I think experience, Neal, like you said, when you submit that actually does hold weight for us. So, when you talk about the experience you've had, whether it's, renovating in the past, or you work with contractors, or you've done it before, you've built 10 other homes, that holds a lot of weight for us.
What if he's a dick?
Well, you got to be a really good dude. I already touched on
well,
this.
That's the thing, man. That's a yes or no. Good dude? Yes, no. Dick, no.
That's kind of the key thing for us, and I'd say that's even more important than credit profile. And I feel like I've mentioned credit profile a bunch of times now. That is lower on the priority for us than the equity or the experience for the client.
Yeah,
no, you can actually see them through, and you can understand sometimes credit profiles get beat up, hence why they're
exactly. And often people we deal with too have high utilization because they have 5, 10, 15 properties, right? Yep. So the credit score might show lower, but we look at that and we take that into consideration, and that is still just as good as someone with an 800 credit score if that's the reason.
I gotta say this because this is a personal situation I'm facing right now, but I have a decent credit score, but I pay all of my bills on time. I have nothing that's behind right now, yet it still went down. It only went down by 2 points. But I just started monitoring it, and now it goes down 1-2 points every time the statement comes out, and it's literally just
because I have so many different your things. Credit.
Well, those apps don't do that.
Yeah.
Do they?
No, that's also a bit of a lifestyle. But a lot of it is you may pay your credit card off religiously every month, but if it has a $5,000 limit and you're at $4,800. That's going to ding your credit regardless. I know it's kind of
wonky. That's what I'm getting dinged on is that I have a high amount of money on my card, but none of it is carryover from the previous month.
Yeah. Also, like you can get real savvy and figure out what day they do that measure and just like put it down to zero on like the
what I'm doing.
13th of the month and then take all the money back out on the 14th. But they don't like that and they charge you more interest on advance. Anyway,
Speaking of interest,
well, yeah, no, before we get into that for a second. So you guys do everything from someone wanting to finance a small home purchase or flip or something like that up until what? Like what's your upper threshold limit?
Upper threshold limit is typically about $3 million in most scenarios. So
Of lent money?
lend money.
Okay.
So, in terms of units, that typically equates to somewhere between 12 to 24 units, I guess, would be kind of the max that we're looking at. So our sweet spot would be somewhere between like 4 units to 24 units, I'd say, for the most part.
Yeah.
And I know you mentioned on a past podcast as well that, some of the big opportunities are going to be in these smaller scale construction of your, 2 to 6 units.
Yeah.
That's been our bread and butter for years, is doing those types of deals where, it might be like 4 townhomes built on slab, targeting a senior demographic or something like that in a Truro or Elmsdale or something like that. We've had a ton of success with that, and the borrower tends to do quite well on that and get the lift they're looking for.
Yeah, so in our last episode, we talked a little bit about new construction, but that'd be an instance like, say someone could get, a really smoking deal on a piece of land and maybe they're able to buy it cash. Say they can come up with the cash to buy a piece of land for $100,000, and then through a development agreement or subdivision, they're now able to knock off 4 units on that lot. Well, now that property goes from $100,000 to potentially worth, $300,000. And then now you have $300,000 worth of equity. And you would come to Ryan and say, okay, here's the cost it's going to take me to complete this project, but I already have $300,000 worth of equity on it. This is the end complete once we've got these 4 units built. And if those numbers jive between your $300,000 of equity in the property and your kind of gap between your as complete and what it costs you to build those structures, now they can lend on it. So that's the sort of thing that we're talking about and that Ryan would kind of have interest in. Is that more or less right?
Exactly right. And typically in that scenario, on that as complete value, we're doing about 65 to 70% of that as complete in terms of your construction budget, right? Or our total loan size.
So like hypothetically, like say you'd be all in on the project for, 4 units, say you could build them really cheap for $800,000. So your all in would be like 1.1 million, but you've got 300,000 in equity. You would loan on the as complete, or
we loan on the as complete. Exactly. So if that comes back and it's, we're funding 700,000 of that, then you've got pretty much your costs covered from the loan.
Because maybe those appraise out at the end at 350 a pop, so they're actually worth whatever that is, 1.4. I mean, you guys got the rings, whatever that math works out to. I think it's 1.4 million, right? So anyway, people can mess around with the calculator and figure that out, but that's a great little hypothetical example there.
Yeah, totally. And so now someone's gone through the whole process, they've gotten approved. What is somebody looking at for expenses on money like that? Like I said,
the rates, yeah.
We want to know rates, and then there's also
And
deal
fees.
fees associated with it. And then I know we'll say like, is there any monitoring expectations? You said you'll come out to site yourself. I don't know if you want to just break down kind of what you see as the whole package. What somebody would face.
Yeah, absolutely. So, we're very transparent with our rates and fees with our clients. So, your biggest consideration is going to be your interest cost, which is going to dictate your monthly payments. There is lender fees associated with it. Typically ranges from 2 to 5%, depending on the situation.
Okay.
And that's basically cost of doing business for private money. But one thing I will mention on our rates as well, in a construction project, which we do a lot of, a renovation loan being the same thing, we only charge interest on the amount that's drawn. So there is some private lenders out there that will say, this is your $400,000 construction loan that we're only advancing $100K on right now,
We're charging on
but we're charging you on the 400. We won't do that. We'll only charge you on what's drawn, and some people don't even end up needing that 400,000. They might only need 250 or 300, right? And they've been able to scrounge up their own cash or whatever else, or make some savings to put towards it, right? So that's been the key thing.
That's super nice. I can say I remember I dealt with a different bank and I had a full construction loan approved, and then I ended up paying interest on all of it. And I was always nervous, but with you guys, I'm like, I'll get the max approved and ready to go, because realistically, I'm not going to pay on it until I draw on the actual amount, and then I pay on specifically that amount on a monthly basis.
So say someone's borrowing $200,000 up front, there's kind of a 2% to 5% fee, so that's $4,000 to $10,000 just for borrowing the funds.
And that's usually withdrawn from the funds that are being advanced.
That's
so
right. So we'd advance 190 instead of 200 in that scenario, right?
Exactly. And then the carrying interest is what? typically?
So it's typically around 1% a month. So it depends. It ranges from 10 to 12% annually. But again, I know that sounds high versus what the banks are at, although it's converging at this point.
I just signed a grade A mortgage at 7%.
Yeah.
At 65 loan to value. And I'm like, God damn.
Yeah. But one thing I always remind, our clients and brokers as well is that it's not apples to apples comparison, right? You're comparing a fully open loan to, a closed loan that's a 5-year term when you're looking at that 3-4-5% interest rate.
I think also it's like you're comparing money that you actually get versus money you don't get.
Exactly.
So it's a non-comparison in a lot of respects.
Absolutely. So you get the flexibility. And the other things I'll mention in terms of fees as well, where, there's legal fees associated, which typically are around $1,000.
Yeah.
And the appraisal fees as well, which is in the range of $400 or $500. You guys might know better than I on that.
Yeah. So realistically, to borrow $200,000 for 6 months would be worst case $10,000 plus
12 grand.
Call it 12 grand.
Yeah. 12 grand.
$25K.
Yeah. So if you're looking at the opportunity to do a project or not do a project over the next 6 months. And you're building out if you're borrowing that amount of money, you're likely involved in a project that's worth hundreds of thousands of dollars. And so your cost exposure might be $25,000 over the scope of the 6-month project to borrow, which again, you're comparing against maybe not getting it at all. But even if you did get it, it would be 60% of that. So really the net swing is maybe 12 grand to do the project or not do the project. And this is why people use it. And this is where my stubbornness opposed to it in hindsight was a mistake. But I was genuinely scared of it.
And totally, and I think you're right to do so, because there is, if you're not smart with it, you can put yourself in a rut. But this was one of the big things for me is when you look at a lot of other loans, by the time they still have lawyers. The other thing that's really nice is, I forget who you guys use, but it's much cheaper than a lot of other banks. When I fund a loan with another bank, I find I'm paying $4 grand in legal fees to fund a mortgage, and I'm like, why? And so there's that aspect that I find you guys have been cheaper on. Appraisals and cost monitoring. Again, you guys are willing to work with almost all appraisers. You guys are willing to come out to site sometimes to help us save money or get things done faster. Cost monitoring and appraisals for other banks can cost thousands of dollars and take tons and tons of time. So there's that aspect. And then, again, the funding timeline, which we'll touch on here in a second. So, and you're still going to pay a deal fee on money that you borrow from a regular bank.
Yep.
And then additionally, where everything's open, when you go to pay out another bank, even on their open products, you might be paying 3 months interest. Once you boil it all out, if you have a project that you're doing in 6 to 9 months, honestly, there is that 25 grand, you're probably spending 20 with a regular bank, but you have a ton of headache, and trying to get that money is a pain in the butt.
Yeah, absolutely. So a couple points I'll make there. Like Chandler mentioned, what's the cost of not doing the loan? And one thing I recommend to brokers when they're positioning this to their clients or when we're dealing directly with clients is, calculate the total dollar cost, just like you mentioned, Neal, right? Mm-hmm. Rather than looking at that percent, the absolute percent, right? So actually calculate what this is going to cost you and look at it as a line item in your budget. Yeah. If it makes sense in your budget, then, it makes sense to do the deal.
Always budget. That's I 100% agree with that. Make sure you put it in your budget. A lot of people don't put their lending costs and legal fees and soft costs into their budgets on these smaller projects, and that can really chew up, especially if you have a tight margin. You're really relying on getting out 20 grand. You got to make sure you put them all in there. And if the numbers make sense, then there's no reason.
I mean, man, if I need to have 15 grand in there for the porta potty, I will slide this line item in there as well.
Absolutely.
So
that's actually maybe steep for the porta potty. Jesus, what are they serving on site? What's the food cart menu like
Taco
there?
Bell.
So we know cost.
Yeah, we should dive into these questions on some personal thoughts about where you think interest rates are heading, because obviously you're hyper tapped into this.
Yeah, so we'll say, so we went to the BOC presentation that's here in Halifax. Tiff Macklin presented.
Yeah, which actually hosted by Credit Union Atlantic.
Yep, it was hosted by CUA.
And Remax. I think we had a little
Remax.
Yeah.
Tiff, if you guys don't know, he's governor of the Bank of Canada. He is quite heavily involved in a lot of the decisions that get made regarding interest rate hikes and what takes place with money being doled out.
He's the face of Canadian monetary policy, for sure.
The face of Canadian monetary policy. Chandler had to withhold himself from getting up on stage and punching him in the face. But the presentation wasn't bad overall. If anything, it gave me less confidence than ever. And we were talking about before we came on, but a lot of his answers seemed to be fairly scripted, and it was very political. Like he's been
regurgitating that speech probably in every
Yeah,
every luncheon that
absolutely.
he's done.
His English to French I was impressed. I was like, damn, he just switched that up like no big deal. Like
Yeah.
he is ready for prime minister. But anyways, we have a couple things we want to get your opinion on because him and I blab about it all the time, and I think everyone's tired of hearing what we think.
Yeah. And you don't feel the pressure to expound, just kind of what your guts, what your thoughts are on these.
We're holding you accountable to your answers.
Sounds good.
The first one is, do you expect rates to continue going up? But like by how much and for how long? Kind of. And again, not exact answers, but roughly overall, are you expecting things to kind of keep running off the charts?
Yeah, I honestly thought we were kind of at the end of it until listening to Tiff speak last week, and now it's clear that we are not at the end of it.
Yeah.
I think we're going to see at least one or two more going into
October
Q1.
27th is the next date, or 28th?
Yeah, so I mean, I think we'll certainly see an increase there, whether it's a quarter point or half point. I have no idea.
Oh, it'll
but
be a half anyway.
Yeah, likely. But I mean, and I think that's likely going to continue until the back half of 2023, realistically.
Like you'll think they'll stay high that, or you think he'll keep
I think
bagging it up?
I think they'll stay high until that point, and then hopefully we'll see some easing at that point.
Yeah.
But yeah, I mean, it's going to create more unpredictability, I think, in the market where this is going. I don't.
Did you guys peg off the bank rates or 5-year?
We don't actually. So CUA would, our parent company, but as a private lender, we don't. So we're not tied to the prime rate. So we actually haven't increased our rate. So like I mentioned before, it's kind of converging towards our rate.
Yeah.
And so that's likely going to create more opportunity for us. The challenge being on the back end for exit strategies, right?
that's-
You can only push so hard.
That's kind of was our final question. Maybe you can speak to it now. Like this is all about the exit strategy. Even you opened talking about the exit strategy. It's something we hound on all the time is like your exit strategy, getting out of these deals. Do you have concern about that moving forward?
Yeah, I do. That's probably my biggest concern going into next year. I think there's going to be, the inventory is still crunched right now, right? So there's still a need for our construction projects and for people to, renovate these multi-unit commercial buildings as well. But unfortunately on the back end, I think we are going to be more challenged with takeouts, or developers are going to be less likely to do it because they're not going to have that same spread when they refinance, and they're having to refinance at a 7 or 8% versus 3 or 4%, right? So I do think that'll be a challenge for us going forward into next year. I still think we will see a lot of opportunity, both with construction, commercial multi-unit loans, like I mentioned, but also bridge financing, which we've seen a lot of in the last couple of years. So we'll likely still see that, but again, we don't want those clients having to stay with us for 2-3 years, because that's when the problems start to rack up.
Is that what you usually do in a scenario like that then? You try and come up with a rate that's basically palatable that they can pay through income and keep the property afloat to try and see to better times?
Yeah, honestly, we luckily haven't had to deal with this a lot in the last couple of years, because the market's been so strong that clients either been able to sell their property, or lenders have seen, a property that we may have had at 70% LTV is now at 55% LTV, and banks much more likely to make an exception and take that out, right?
Yeah.
So if that starts going the other way and values are decreasing, obviously we're going to be more challenged there. So I don't know. I'm hopeful that we're going to see it ease a little bit, but based on what Governor Macklem said last week, it sounds like he wants to keep hammering us over the head with the increased rates.
Yeah. Do you think banks are going to start calling loans? Do you think there's going to be default issues? Like, what do you foresee there?
I think it's definitely going to increase. So, I'm proud to say that I think we had 0 foreclosures in 2020 and in 2021. And typically, historically, we would see that as a bad thing, that we're not taking enough risk, because in our business, it's bound to happen, right?
Yeah.
Just given the type of business we're
in.
in.
That's interesting.
But typically, we do like to keep that to a low percentage. We've started to see that creep back to historical norms, which is fine.
What are historical norms?
Below 5%. So I'd say our target's typically 3 to 4%.
Right.
For foreclosure rates, so significantly higher than the banks would have, but very normal for private lending.
They try to say sub 2%, is it, or even lower than that?
Even lower than
it's
that,
even
like
lower than that.
0.2%.
They're
I think is the
wow,
target.
wow. Okay,
Yeah,
so like not at all.
Yeah,
Wow.
basically not at all. So,
Yeah,
I know they don't want any, but I just assume like
but they still do.
There's a level of risk.
Right.
They
They don't
wanna
assume
just
as a business
sprinkle
that you have
risk
to
with
take
it.
They don't
on.
want to just
you know.
sprinkle a couple defaults. For
So,
seasoning.
Goddamn.
yeah, to answer your question, I think definitely, hopefully there's, more flexibility flexibility and not as many called loans. Like I said, with us, like we want to avoid that at all cost, and we understand that there's external market forces that are happening here. So as long as the client's kind of holding up their end of the bargain, or if they're really not able to make those payments for whatever reason, we come up with a payment arrangement, right, to get them that additional 3 months or 6 months they need to get out.
So, and again, just so people know, when you're saying calling a loan, like there's a couple options I think within that. They're literally wanting to get out of that property and not work on be a part of it anymore, so they need to get paid out, and they're usually putting a short term on it, like being like within 180 days or 90 days even, we need you to pay us out to get us out of this property. Or additionally, and I don't know if we've seen this here, but you want to pay down the loan to value. So like we've now reassessed.
Yep.
Rental cash flows are not going to cover this amount of debt.
You need to put a lump
and
sum.
so now you need to give us another couple $100,000 to reduce this loan, which
that's going to become more complex.
I've talked about it before. It's a scary thing, and just because if you have a bunch of properties that are at a high leverage ratio, and then the loans are all needing to be called, or you need to dump down $100,000 on each of them, and you don't have that available, you could be forced, your hand could be forced to sell something at potentially not a great number just to literally pay out the loan.
Yeah, that's a great point, Neal. And one thing I didn't mention is that our loans are interest-only loans as well. So typically, if you're paying P&I to us, that means you're on the shit list. So
That's
we typically want to avoid
plus
that.
Interest. Yeah.
Principal plus interest. Thank you. But yeah, I mean, there is scenarios where people do want to pay down principal as well, and it makes sense, and it helps them with the takeout as well if they can pay it down by a little bit. Okay. But that's another benefit of our open loans as well, is that people can make those principal payments. Say you get a big bonus or something, or you sell off another piece of real estate and you want to put $50,000 down on the loan. We can do that, and there's no penalties to do that, and you can do as much or as little as you want in a given year.
Yeah. Also, not having a principal component of your monthly payment keeps that cash flow similar to if you had an A lender on the deal, which again, if you're going through a project for 6 months, you are most concerned with cash flow. So it could get it closer again to net zero versus going to a primary lender, an A lender.
Could you see yourselves, if someone gets, let's say an A lender calls someone's loan, could you see yourselves stepping in to pay out that A lender with another exit strategy, or what would you guys be looking for there?
We've done that before. Are you kind of talking in terms of like saving them from foreclosure?
Yes.
Yeah. We've done that before, but typically the loan to value has to be in such an area where there's enough equity there where we might be able to build in an interest reserve and cover payments for those 6 months or 12 months. Yeah, and we need a pretty locked down exit strategy for something like that. Like we are going to sell the property within this time frame. Well, that's just it.
If they've got that much like equity in the property, they're really treading water, and the bank's probably like, sell the damn thing.
Exactly.
Right? And they'd come to you and you'd probably say, yeah, we'll help you out for a period, but then you might have to sell the damn thing to recover this. Yeah.
And that is an acceptable exit strategy for us too. If they're willing to sell the property and we feel where they're going to price the property makes sense, then we have explored those situations before, but it has to be the right fit because those are naturally higher risk clients.
Yeah, that makes sense. Obviously, because you're basically taking over a failed setup with somebody else, and you're hoping to turn that around. So I was just curious what that looks like. Again, I'm a bit of a fear monger. I'm just concerned about where things are going in this next year. But I don't think I have much else. Like I said, you think you said the rates, you see a couple more hikes this year and staying through to the end of next year. Do you think you'll see more rate hikes next year? Like my opinion, I feel like walking away from TIF is I feel like there's like 100 plus basis points to go.
Well, man, 100 points is nothing, though. At the rate we're going, 100 points is nothing.
Chandler lives for massive rate hikes. He's on all variable products. Just a couple 300-400 basis points, whatever for Chandler. But for the rest of us,
stick it to me.
I think, from my perspective, if I had to guess, and it is complete guess, I think there'll be one more this year, one more next year, and then hopefully we'll start to see it either level off or trend down. Because
you think they'll give us a Christmas break? I was kind of thinking they might give us a Christmas break.
I don't know about
because
that.
They've got a meeting. Well, they've got a meeting at the end of this month, October, and then they've got a meeting. There's nothing in November, and there's one in December as well. I think at a minimum we're going to see 50 points here in a week. Right?
I bumped into Tiff at the Halloween store with a Grinch costume, so I think we're getting a big Christmas bonus. Well, he's getting a big Christmas bonus.
Yeah, so I mean, like to see 100 points by the end of the year is very, very possible. Very possible.
But I mean, to your point, Chandler, on I think it was a previous episode you guys had where we're not seeing the effects of the past rate increases.
Yeah, this mother
with
won't
the
even give it a
effective-
chance.
Exactly. And inflation is starting to go down. It's starting to trend down. So rather than like, I was kind of surprised where he basically told us that it is going to go up again. Because if you guys had asked me this before that, I would have said we're probably done and we're not going to have any more this year.
Listen, by all indications, we're already rolling over, right? Like, so
Hold the
it's
phone.
it's kind of like, you're going up this hill, right? And there's always this lag, and you start putting this downward pressure on it. But when you put the pressure point here, it still continues up for a bit, and then it starts to roll over. So now you're going downhill, and it's like at a certain point when you're going downhill, you can stop pedaling, right? And you can coast down the hill, and he's still pedaling full tilt on his little training wheeled bike. I can't stand this.
You
man.
want to go after this guy? Let me pause for a second. Remember in the presentation, the one thing I did get from it was when you exclude factors like gas and food,
Core inflation,
and you just look at core inflation, it hasn't moved a ton. And so there's that aspect. The other thing that
Hasn't moved at all.
It hadn't moved at all. It was at 5%. It hadn't moved at all. So that target they're trying to bring down. That's why they're creeping increased rates. But I do think in time it'll start to move. The other thing, I think, listening to him, it sounded like the focus of the BOC almost is more on, which makes sense, basically the value of our currency.
I didn't think that from
Than
it
the
at all.
actual homeowner. Like at the end of the day, Nancy's not gonna be able to have all the fancy food for Christmas, but if our currency plummets to a value that's worthless, no one's gonna have any nice food for the rest of Christmases.
Yeah, I didn't necessarily
he kept
take
talking
that
about
from it.
runaway inflation.
My whole thing that I took from it is that he basically said the labor market's too hot.
Totally.
Unemployment's
for
too
runaway
low.
inflation.
Wages are too high. The labor market is still way too hot, and that's the thing. People, and I said this before, and people didn't like it. Like, until people are unemployed, they're going to keep these raises up. So we were tracking unemployment for a while, and like all these layoffs. And again,
It's
you
shot
can
back
see
down.
those things like. Yes and no, man. Like, you can still hear the whispers of it because those take forever. And we talked about this last episode about unemployment is the last thing to go. The housing market's the first thing to topple, and it toppling is a sign that inflation is cooling, but it just happens so quickly. All the other things, consumer buying, then orders, then profits, then unemployment. So we're somewhere in this downward projection, but he's just still pedaling full tilt.
I don't know. Coming out of that presentation, I'm not feeling super convinced.
No. He's going to raise them. There's no question. But I also think what's really interesting is when this episode drops. I don't know when this episode's going to come out, but shortly, actually, probably as this episode drops, we're going to get the inflation numbers for September, and those are going to be huge. I think it was 7% in August, which was deemed as a win. We need to see that sucker under 7%.
Still on the thing,
He's still going to raise it,
core
but
inflation, man, core inflation, because we talked about it. Gas prices are artificially manipulated by just dropping the crap out of the reserves. So eventually those will go back up. Like, it doesn't really mean anything.
But even like core inflation has started to level, right? And again, you're talking about this thing as it crescents and then it starts rolling over. Like, you have to look forward, and it's so ironic that they didn't look forward whatsoever when things were going to the moon, right? He was just chilling, and then now he's kind of hasn't learned. But we need to wrap it up.
We let Ryan go.
Yeah.
We also have to go to a meeting.
Yeah, really appreciate the insight.
Yeah, thanks for
guys.
coming in. Anything else you want to add?
No, nothing in particular. It was a lot of fun. Appreciate you guys
we'll put
having
all
me
your
on.
details so people can connect with
Absolutely.
you. You guys are even on Instagram. I think you have 2 Instagram accounts because one got hacked or something like that.
I didn't want to mention that, but thanks anyways.
But,
Graceburg_capital. Stick with that one.
We'll make sure people have your credentials, and obviously people can reach out to us for a small referral fee. We will gladly say
Exactly. Text us direct, and then for 1,000. No, so I want to add in as a last thing. Obviously, thanks for coming in and everything like that. But I do want to say, obviously, Graceburg's been amazing for me. They've basically got me started. They allowed me to grow a ton. I'm now going through all the exit strategies and cleaning things up. But I also want to add, we didn't really talk about it, but the service level has been awesome. Responsiveness.
I didn't realize this episode was sponsored.
Yeah,
are we charging?
No, I'm just
Is
doing it
now.
because Ryan's the man. So, and they've always been so responsive, but everybody, all your staff too. I send an email, and within 30, 40 minutes, I have an answer, which is so valuable. When you're in there and you have all this money out, it's super stressful, and you're looking for answers. And if you have to wait 3-4 days, or you have to call the bank 5 times to get through, it means nothing. So that's another thing I just want to add in there before we finish up. But
Speed and service are at the core of our business, so I appreciate the kind words, Neal.
yeah,
Cheers.
awesome. So thanks for coming on.
Thanks again, man. Really appreciate it.
Any other questions, guys? Leave them in the comments, and we'll make Ryan answer them in an email.
Comment, reach out. You know the deal.
Yeah. Peace.
When I was broke, I had rich habits. When I was broke, I had rich habits.